Hey guys, this is Andrew Keen from KeenOnTheMarket.com. This is your unusual option activity report for February 23rd, 2012. We had 5 unusual option activity trades today. I took one of them. It's very hard to trade everything every day. I try to pick the best spots, and then I have a trade of the day, which I think is the highest probable trade of the day. Then I have trade of the week, which is the highest probable trades of the week, in my opinion. Just remember, I can't tell you how to trade your money. I can only tell you how I trade my own. First one, I'll look at is Sony. Sony has been grinding higher for the last couple days. Looks very strong. Bottom around the $17.50 level, and it looks like it could have a run even higher. I think it could run probably to this 22.5 level. If we just pull in a couple lines. I think it can get to right here, 22.5. Customer came in when stock was trading $20.94 and bought the July 23 calls for 90 cents. I saw about 5,000 of those print. I didn't jump on board just yet. I wanted to see a little bit more momentum, a little bit more upside. Then they came about these calls for 95. I bought them for 95 as well. I talked about it on Twitter. And then I sold 10% of my position out at 110. I was trying to sell 20% of my position, but I only got filled on 10% at 110. That's a 17% profit in the day. Also, I saw a customer buy July 22 calls and sell July 16 puts. So that is more bullish activity in Sony. FTR, a customer sold 55,400 of the May 4-5 strangles for 27.5 cents. This is a huge order. This customer is willing to get long FTR at 372. If I do a little quick math, and he's willing to short it at 527 between now and May. And he's collecting premium. This could be a volatility play. I did not trade it at all. IAU, gold stock. Gold's been on fire lately. If we see this, just grinding higher as well. So when the stock was trading $17.38, customer sold 10,000 April 18 calls for 25 cents. A lot of times when a customer sells calls, I don't take the trades on because it could be against stock position. When you sell puts, most likely there's not a short stock position on. However, when customer sells calls, there could be a long stock position on. So I did not take this trade. AEP, I used to trade this one. I've gotten myself in trouble trading this one as well. When stock was trading $38.21, a customer sold the March 38 calls for 70 cents. I would have bought these. I tried to get on the trade and I got faded, so I did not take that one on. That was 7 times the usual volume. Next one I'm going to look at, they talked about on CNBC earlier today, was SLV. When the stock was trading around $33.85, customer came in, bought June 36 calls for 190 and June 35 calls for 220. 2.5 times the usual volume. I've been staying out of the silver and gold trade for a while. I'm long physical gold and silver. I basically will hold it for a very, very long time unless silver gets to 50 or gold gets to 2,500. So it's in my positions in my portfolio. I didn't like this one as well because we saw a lot of neutral pattern up here on this 34.50, 35 level. This could be a top right around this 34.80, and a customer could be buying some calls and trying to short silver. Because volatility across the board is really cheap. Let's talk about a couple of my earning plays that I put on. First one in Deckers. This one's going to work out like a champ. I'm going to change this to timetable of 24 hours because we're in the Globex session right now. So let me just change it up for you guys. And here we go in Deckers. I want to first look at the daily chart. And in the daily chart, I thought Deckers was looking a little toppy around this 92.5. I thought I was going to have difficulty getting over 92.5. This is where it sold off hard. What is resistance becomes support, support comes resistance. So I thought it would not get through the 92.5. I sold the 92.5, 95 call spread for 105. It could be worth 250. I sold it for 105. I'm risking $145 for every $105 I'm going to make. And if we look at the 5-minute chart, good night, 82 bucks. So this trade, most likely, this spread will go to about a nickel or maybe even be worthless. I will probably take it off for a nickel if I can, because every time a trade changes, my risk reward changes. Let's say it goes to 5 cents tomorrow. Would I rather pay 5 cents because now I'm risking $245 to make $5 on it? So tomorrow, if I can get this thing for a nickel, I'll put it on. Next one, GPS. I also did the underneath play on this one. This one looks pretty good too. I thought GPS would sell off. However, I didn't think it would sell off too much. We looked at this in Dell as well. It looks like it's got some buying pressure on this 21.5, and the gap from 22. So I thought it would sell off, and I think it would sit around this 22 level, maybe 22.5. So what I did is I sold the March 24 25 call spread, but I also sold the March 22 21 put spread. I did this as a package for 48 cents. As long as gap GPS stays between 21.5 and 24.5 between now and March expiration, the trade will be profitable. I'm risking $48. I'm risking $52 to make $48 per one lot. And with stock selling right around this 23.30, looks good. Volatility would crush a little bit, and this will be a winning trade tomorrow. I will reevaluate it tomorrow to see if I want to take it off. Next one, CRM. This is the most confusing options play that I put on and the hardest one to understand. So we'll look at the 5 minutes, just to give you the trade. It's about 145 right now. What I did in this one was there was an implied mood of $11. The weekly straddle was $11. When stock was 130, I bought the March 120, 140 strangle. So I bought March 120 puts, and I bought March 140 calls, and then I sold the weekly 120 puts and 140 calls. This is called a straddle swap. I bought Marches and I bought Marches and I sold the weeklies. Basically, what I want to do, my golden landing would be 140, which broke through pretty hard to 145, or 120. These were two levels I thought I could end up at. Right now at 145, we'll see how tomorrow. It's a hard trade to understand and explain because March volatility will be important for me. If March volatility stays relatively high, then this trade will work out. If it gets absolutely crushed, the most I can lose on this trade is what I paid for the straddle swap. I paid $2.69. I will re-examine this trade tomorrow, and I will put it on the blog, and I will tweet about it. Remember, if you want all the unusual option activity, trades of the week, or trades of the day, you have to go to keenonthemarket.com. Hopefully, these are better explanations of the earnings trades because I know some of them get confusing. If you have any questions, email me at andrew@keenonthemarket.com. Have a great night.